Okay, let's just get right into it. Because, right now, there's this massive, palpable wave of anxiety rippling through the economy. Seriously, if you've been glancing at the news or checking your portfolio lately, you are probably asking yourself the exact same thing everyone else is. Are we standing on the brink of a historic, nasty collapse? Or are we literally at the starting line of an unbelievable market melt-up? Well, in today's Explainer, we're going to break down the fascinating mechanics of what's actually happening beneath the surface of the economy. We're going to zero in on the bond market and those high-flying AI stocks to figure out what the data is really telling us. $1 trillion. I mean, believe it or not, the United States is quietly laying the groundwork for a massive intervention, an estimated $1 trillion bailout just to keep the economy stable. And honestly, the wildest part about this, the whole shebang is happening right now at a time when stocks are just as incredibly expensive as they were at the absolute peak of the dot-com bubble. So we have to ask, what is actually going on behind the scenes to trigger this kind of extreme response? So here's our roadmap for today. First, the hidden market bailout. Second, the case for a bubble. Third, the case for growth. Fourth, Fidelity's red flags. And finally, surviving market irrationality. All right, kicking things off with part one, the hidden market bailout. So to really grasp where this market is heading, we've got to talk about yield control. You see, what actually drives the markets isn't always just company profits. A lot of the time, it's interest rates. Recently, investors have been getting super anxious about long-term inflation just stubbornly continuing to grow. And you know how it goes. If you think inflation is going to run hot, you demand a higher interest rate on your money to make up for that risk. But that creates this massive, crushing strain on the national debt, on mortgage rates, and really the broader economy. So, to fix this, the government triggers yield control. They step in and literally buy their own long-term treasuries. By printing money and buying up these bonds, they artificially force those out-of-control interest rates back down. Essentially, it's a backdoor market bailout. And you know what's crazy? This tactic is actually nothing new. We saw the US use yield control way back in the 1940s to finance World War II with cheap money. And a fascinating little side effect of that, the stock market eventually rallied 187%. Then, of course, we saw different flavors of quantitative easing in 2008, the massive pandemic interventions in 2020, and now today's market bailout. Every single time they pull this lever, it's designed to prevent a total market meltdown, which naturally makes any savvy investor stop and ask, wait, what does the government know that the rest of the market hasn't priced in yet? Moving right along to section 2, the case for a bubble. Are we just reliving past crashes? Legendary investor Jeremy Grantham recently dropped a bit of a bomb, literally calling our current situation the biggest investment bubble in American history. And look, when you strip away the hype and look at the raw data, it's pretty easy to see why he's so agitated. The Buffett Indicator, that famous metric used to value the overall stock market against GDP, it recently hit an all-time high of over 230%. That aggressively signals that the market might be priced twice as high as it fundamentally should be. So there are really 5 core concerns driving this massive bear case. First off, we're looking at an extremely expensive market, with valuation ratios sitting right where they were during the peak of the dot-com bubble. Second is weak monetization. MIT researchers actually found that roughly 95% of AI pilots currently deliver absolutely zero measurable impact to profits. No way, right? Third is circular financing. Fourth, we're seeing intense tech bubble similarities where all this infrastructure is being built way, way ahead of any proven cash flows. And fifth, extreme concentration. Right now, it's estimated that a staggering 87% of all venture capital is flowing straight into AI. Actually, let's double-click on that circular financing point for a second, because it's a wildly important concept. Just imagine I give $10 to Tom, Tom gives $10 to John, and then John hands that $10 right back to me. Now, on paper, we all get to record $10 of revenue on our books, but in reality, it's literally just the exact same $10 bill shuffling around in a circle. Critics are arguing that large tech firms are doing exactly this right now, investing in, buying from, and guaranteeing capacity from one another just to artificially boost their perceived revenues. But let's flip the script. Section 3, the case for growth and a credible path higher. Because on the other side of the debate, the bulls have some seriously strong, optimistic data. Here are 5 huge reasons for sustained growth. Number 1, internal cash profits. Unlike past bubbles, these massive AI buildouts by the big tech giants, they're actually being funded by their own giant piles of cash, not by racking up dangerous debt. Second, rapid growth. Cloud AI run rates are literally seeing triple-digit percentage increases. Third, lower valuations than 2000. Yes, it's expensive for sure, but we aren't seeing those insane, sky-high multiples on heavily unprofitable companies like we did 30 years ago. Fourth, low IPO activity. We just don't have that crazy frenzy of low-quality companies rushing to go public just to cash in. And fifth, the need for a catalyst. Let's pause on that last point because honestly, it is absolutely vital for understanding market psychology. Rallies do not just magically end simply because the price is deemed too high. They don't. They require an unforeseen catalyst to trigger a cascade of panic selling. Right now, even with sky-high prices, international conflicts, rising oil, you name it, there hasn't been a sudden, unexpected trigger to derail the innovation train. Without a genuine shock to the system, markets can just stubbornly keep melting upward. Which brings us to Section 4, Fidelity's red flags, the actual signs a bubble might be bursting. Okay, so if we are going to crash, what should we be looking out for? Fidelity put together this specific list of red flags. If these start flashing, yeah, it's time to worry. First, high cash burn rates, companies just bleeding money faster than they make it to keep up with the AI race. Second, intertwined business ownership. Basically, if one major player goes down, they drag everyone else down with them. Third, debt levels growing completely out of proportion to actual profits. But that fourth one, that is wild. AI hitting physical energy limits. We're talking about the literal power grid capping how much these systems can physically grow. And finally, higher borrowing costs. But the catch is, until these red flags start waving aggressively, institutions like Fidelity actually believe the market is just going to keep scaling as other sectors adopt the tech. It perfectly captures this brilliant mindset you really need to maintain. The stock market's job is to make you say, this makes absolutely no sense. The market is surprisingly efficient, but you gotta remember, it doesn't care at all about what is happening today. It only cares about pricing in the possibilities of tomorrow. So what feels incredibly irrational or totally overpriced to us right now is often just the market looking 5 years down the road. Okay, bringing it all home. Section 5, Surviving Market Irrationality and How to Actually Protect Yourself. Look, there's a reason everyone in finance repeats that old saying, the market can remain irrational longer than you can remain solvent. Because, impartially speaking, predicting the future is almost always a losing game. You could build the most flawless, brilliant, data-backed thesis that the market is going to crash tomorrow, and then, boom, some random catalyst like surprise money printing gets announced, and your perfect thesis is completely destroyed. Or you bet everything on a melt-up and suddenly unpredicted global tariffs hit. You literally cannot predict these random catalysts. So you have to protect yourself against both extremes. So how do you do that? Here is a visual blueprint for survival. It really comes down to deep, stubborn diversification. You don't have to pick a side between the bulls and the bears. By spreading your exposure across US markets, international markets, holding maybe 20 to 25% in steady yield-generating treasuries, mixing in some physical real estate, and hey, maybe even exploring a small slice of a crypto or Bitcoin ETF, you're building a fortress. This kind of defensive structure allows you to survive and patiently capitalize, completely regardless of whether the market crashes or melts up. So after looking at all this data, it really all boils down to one single provocative question. Are you prepared for wherever the financial system leads us next? Instead of trying to outsmart a totally unpredictable economy or panic selling at the worst possible moment, prioritize patience. Let the data inform you, but let consistent diversification protect you. Thank you so much for joining me on this explainer. Stay curious, stay structured, and keep learning.